everyone. I hope everyone is doing well. Like Kensley said, a lot of things happening here. Maybe before we jump into this, I will share a few things. First thing is, back in 2017, there was a huge change. Some of the changes that already happened, they are permanent. Honestly, people keep on saying big bill is 800 pages long, but the one actually made people quit in accounting was when to 2017 the entire law changed and it was so hard. But this is actually on top of that. It's very complicated if you really get into detail. So we're not going to get into too much detail. The good thing is that some of the rules are finalized, but you guys do have to understand they will come up with regulations to explain what they exactly mean, because some of the things are not clear. They just say we want to do this and they will have to expand on it. So it takes time for them to actually give us all the details, and we monitor that. So why am I saying that is for a few things. Kinsley and our marketing team has working really hard on creating some of the contents, and if you do not follow any social media, you should, because we have been pouring time and money, and it's only going to get better to get this content out going forward. There's one specific reason. The reason is, if you guys have been following us, you would know this. We are developing a tax planning software. Planning, not filing. Our normal planning for your CPAs costs around 5,000 and up minimum, and that's a huge amount of money. It does save you taxes. For last multiple years, I have been working on this software. Now it's about to be launched, which incorporates not only the new laws but anything you can possibly imagine, and AI based. I'm sharing because if you understand what I'm talking about today, and if you understand all the concept we have been sharing in the last few years, you can do your own planning, literally for an $800 or what, I don't know, I haven't priced it yet. But rather than paying 5,000 or 10,000, you can literally pay $800 on something to run your own tax planning file. It gives you detailed action items, contracts, and everything. Let's say you want to hire your kid, but you need to sign a contract with them in time sheets, right? We give you all those resources in detail. You can download it, you can execute it. You can even ask AI or our own support team to, if you have questions. So it's a full support tax planning software. Everyone's going to use it, I know, but you guys are in the forefront of this because you have been working with us. If you are working with clients, you know these laws. We have walked you through our tax planning. So you guys are going to do even better and get most out of the software. That is why understanding these rules is good. AI has changed the game. Before, you guys did not know all the answers. Now, you can ask questions to any AI. It will give you almost 90% right answer. With the tax planning software we have, you don't need a CPA for tax planning anymore. To be extremely honest, CPAs are outdated now because you have the most powerful CPAs on your palm, and let's say ChatGPT cannot give you tax planning advice because I know they're still wrong, but we are creating this software which is going to make you answer all the questions correctly. You can use that to do your tax planning. All in all, before we move on to this new law, I want you to understand what changed, and then also following everything in our social media. We'll show that at the end. If not, just do Google investor friendly CPA, we're everywhere. You will learn a lot. TaxMD is our software, just like a WebMD. TaxMD.com is going to be our tax planning software. It's not live yet. We have 3 or 4 months before it goes live. So if you follow us online, you'll see us training about this, and you're going to change your tax planning game in the coming months. I just want to tell you that before we move on to this bill. So you can share that screen so everyone can follow, because I know it's a lot of information, and I'll explain a few things. So I want everyone to understand one thing. There are a lot of changes. There are only a few things that actually matters the most. There's a big one is obviously bonus depreciation, but some people don't understand what has changed from a year ago to this. I'll show you the numbers. Why is it so important for the next 5 years? It says up to 2029. It might extend after that. But with the market, you know how the interest rate might come down because of all this, the Fed and all the drama we have. It will come down. The interest rate is going to come down. The real estate market is cooling off. And with 100% bonus depreciation, perfect time for you guys to either invest in commercial property, long-term rental, or short-term rental. Do a property analysis. We have been sending you these analyzers for even commercial properties, even for other turnkey properties. If you don't have it, email us. We'll send it to you again. Analyze the property and then understand this, and you're going to do great. At the end of this presentation, which is not very long, I will walk you through what I mean by from 40% bonus depreciation, which was supposed to be in 2025, to 100%. How much of a change are we talking about from tax saving standpoint? I'll show you that, and it will make you feel better, okay? But other than that, I'm going to go through these changes and explain you what you should be thinking. And let me recap when I say what you should be thinking. If I start giving you details about how it's going to float your tax return, no one cares because that's not how you should digest this information. You just need to know, okay, this changed. And then if I'm going to buy a new car, actually it's going to help me. If I buy a new property, it's going to help me in this way. If you understand that, you're going to make the right decision from now until end of the year is all you need to understand. If you want to know specific that applies to your situation, that's why we are here. You don't have to be our clients. I can see we have 100 people. Not every one of you is our client. I understand. You can always email us. We'll say our email, our social media. Just email and we'll reply back because that's how we are. So that's how you digest this information. So let's go to this bonus depreciation. There are some things that people do not understand. Bonus depreciation is just not for real estate. Okay, if you own any kind of other business, it applies for your furniture, it applies for your car, vehicles. It applies for any asset that's less than 20 years. If you buy something and the life of the asset is less than 20 years, this applies because a lot of people are talking about bonus depreciation for real estate, which is also true. It's a big benefit. Let me give you an example. This will make things clear. If you open up another business today, not real estate, okay, go open up another restaurant. What happens in a restaurant the first year is you get lost usually because you spend a lot of money to keep it up and running. You cannot use Section 179. Right below this bonus depreciation on my screen, it says Section 179. Section 179 is also same as bonus depreciation almost because you also get to deduct things up to $2.5 million right away. But you have to have income for that. For Section 179, you have to have income. For bonus depreciation, you don't have to have income. That is why bonus is better, especially 100%. Do you need to understand all of this? No, your CPA will help you choose which one is better for you. But what I'm trying to tell you is bonus depreciation for real estate is great, but it also applies for, let's say you buy a furniture for your restaurant, and you buy a gas station, and you buy shelves for a fridge. You can deduct that at 100% as well if you were limited under Section 179. So all you need to understand with bonus depreciation is it is back, right? Everyone knows this. How it affects you in your tax bracket for the next few years is what you need to think about. Now, let me give you an actionable item for 2024, which is last year versus this year. Should you take bonus depreciation on some of the assets you're trying to be aggressive in 2024 is the best thing you need to understand because we have changed this to our clients. As soon as this was live, there were some people and taxpayers who wanted to be aggressive for last year. When I said last year, I meant 2024. They said even though the asset was not placed in service, they wanted to write it off in 2024. They made it seem like it was in service. Now you don't have to do that because now if you put the asset in service in 2025, it's much better because you get to write off 100% versus 40%. So if you haven't filed a tax return, something you need to think about. But if you have filed it, you can always amend it. It makes a huge difference. Your CPAs, if you work with them on tax planning, they can walk you through the difference and how much savings we're talking about. Okay. So that's how you think. Bonus depreciation is back. Make sure it serves you to change placed in service state some of the assets you have placed in 2024 into action item for bonus depreciation. Next action item is the beauty of this bonus depreciation is it's not prorated, meaning you can buy an asset in December, real estate in December, you still get to write off entire 100% of it, even though it's in December. You don't have to prorate by month. That is why you have 5 months from now to buy any asset, cash flowing real estate, or any assets for your business that really helps you, and then get that deduction. So you're not losing out if you understand how it works. So that's all. With bonus depreciation, we're going to move on to the Section 179. Section 179 is the exact same thing as bonus depreciation, to be honest with you. Section 179 is very lucrative when bonus depreciation is not at 100%. Because Section 179, you can write off up to 1 million 2.5 billion of some of these assets, not real estate. Okay, I'm talking about furniture and equipment. But if bonus depreciation is at 100%, then Section 179 does not get used that much because Section 179 is more restrictive. Like I said before, you have to have income as a business to even deduct it. Otherwise, it gets carried over. Bonus depreciation, there's no income limitation. There's investment income. If you invest in an asset 4 million and more, then it phases out. So there are a lot of other things that you don't need to really think about right now. The good news is this 100% bonus depreciation is better than 6179 at federal level. At state level is opposite. And again, this is your CPAs. They need to explain this to you. I'm not going to go over that right now because it's too complicated for this general meeting. Next one, which applies to everyone, is a SALT cap. SALT is basically state, SALT, state and local tax. That's what it is. This is a good news because it was limited to 10,000 before. And people who live in California, New York, and more expensive state used to not get benefit of all the taxes they pay to the state. Now it has increased from 10,000 to 40,000, which is a good news because now you can itemize more. Can you guys change this timing? There's only one thing you can do, action item, and I'll tell you. Sometimes next year's real estate tax you can pay this year. That's the local tax, and then you can combine them. That's the only action item you have. Follow us on social media. We'll share this, how to exactly do this, because you have to go through some steps. There's nothing you guys need to think, oh, this is going to change my life. It's not like that. It's not a huge change. All I'm saying is it just increased. It helps you. There's only one action item you can take to manage when you want to pay the real estate tax upfront. And there's also some limitations on that anyway. You can manipulate this with state taxes, meaning you cannot pay next 3 years taxes this year, state tax, and get deduction this year. You can manipulate this like in other things. There's only one thing you can manipulate and use again loophole, which is a real estate taxes. You can prepay that for next year. And we'll give you this in writing in the next few weeks because you guys have time to do this in December. Next one is the new car loan interest deduction. It's as simple as that sound. You don't have to itemize. You don't have to have standard deduction. It's above the line deduction. Everyone gets it. If it's a new loan, 10,000 is a great amount of interest deduction. So it helps you deduct. It's almost like a double deduction. If you buy a vehicle, even though it's financed, you still get to write off the vehicle. You know that strategy. It's used for business. On top of that, you also get to write off the interest. Isn't that amazing? Buying a vehicle this year is very important. With 100% bonus depreciation, you could write off the vehicle, first of all. With Section 179, you could write off the vehicle, one or the other. And then on top of that, you also get rid of the interest payment. You're getting money to write off for things going forward. You understand that there are limitations on which vehicles and everything. Your dealership will push this for you. So just make sure it's a US manufacturer assembly, a lot of rules around there, and it will be more clarified. There will be a lot of exceptions. Some of the company will lobby again and they will come up with a vehicle. It could be assembled in China, but it has to be in parking lot for this many months. They'll come up with random rules in the next few months. Just wait. But right now it's US manufactured. That's what they say. And there's a specific definition on that one. Your dealership will give you even more detail on this one. You don't even have to access CPAs because they want to sell you the car. So I know it's a lot of information on the first slide. I'm going a little more deep into these ones because this applies to all, and then it's better than others we're going to discuss. We have some questions, we'll answer them later on, but can you go to the next one? See, these are all very simple. Saving accounts, you go to the bank, you open up the account. Bank would probably initiate from treasury deposits at $1,000, and then after that, this gets funded. You can withdraw until you're 18. Parents or relatives can actually put 5,000 every single year. So basically, it's a retirement account for a kid, which is great. And you can only invest in simple stocks. People don't realize this, but this can change your children's future. Every kid who's less than 8 right now could be a millionaire just because of this. So it's a great thing. What's the action item here? Have a kid who's less than 8 years old and go open up the account at the bank. And they will initiate everything. From what we understand, we're still waiting for more detail, but just say, hey, I want to open a Trump saving account. And they will verify everything. They'll open it up. And they will initiate with the treasury and it gets funded. From what we understand so far, okay? That's all it is. Child tax credit. Everyone understand this. You get a child tax credit. It's nothing that your tax should automatically gives you credit if you're qualified. One thing, how should you think about getting this credit? Let's talk about how the credit works. I just want you guys to understand how you manage your credit. Not just this. As you guys make more money, your credit does get limited. You guys know this. Not everyone gets limited, right? However, though, if you do real estate, if you do bonus depreciation, 6179, if you can lower your AGI, then you can start getting credits. That is why you need to see how the interplay between credit and deduction works. This is why you need that software. The one we're building, it's AI based. You can ask what happens if this happens, and to basically redo your tax, redo your entire thing. Even CPAs don't have the capacity to do that. They have to go and make a fake tax return and run numbers. It's so hard. But that's what you're going to do this year. All you need to understand right now is the concept. so you can do your own tax planning. When you buy a real estate and do cost segregation and reduce your taxable income, if you have 2 kids, you might get extra $5,000 of credit, not even deduction, I'm talking about credit because of all the tax planning you do. And there are so many other credits that works the same way. Education credit, and if you have kids. So that's how you should think. Other than that, it's not like you can change the child tax credit by having more kids. You just have to manage your income so you get credit. How do you manage your income and deduction? You need to understand how they work. So if you can do anything to lower your AGI, if you are above the AGI, then your credit also gets affected. So understand that. So to recap what I said, I know it's complicated if you're not in the same space. All I'm saying is, if you can buy a vehicle, if you can buy a furniture and write off with bonus depreciation and it lowers you so that you qualify for credit, is the only way you can manipulate the credit, is what I'm saying. You cannot go and have more kids. You cannot fake your kids. You can reduce your income so you can get credit if you don't qualify for credit. The tax law just increased the amount, and you could read that without me even talking about it, right? So that's the only value I can add is how you manage the credit. Tax-free income and overtime income. You don't have to pay any taxes on tips or an overtime income up to a certain amount on the screen. You get to write off that in your tax return. There are some limitations you need to understand. Let's say, for example, I'm in accounting industry. If you're in law, if you're in healthcare, people can convert your salary to tips, so you don't have to pay taxes. There are some limitations. These are mostly focused on the wage worker in the restaurant where they get tips. You cannot tell your employer, hey, convert some of my income to tip and I don't have to pay taxes. Okay. Other than that, your kids who work in the restaurant, they benefit from this, and which is a good amount, 25,000 on tips. It's a good amount of tax savings for people who work in the restaurant, and if you have kids who work there for in college, it helps them. So that's all on this space. I will answer a question at the end, but let's go to the next page. Income tax bracket made permanent. That's all it is. The tax bracket did change. It was not permanent before under Tax Cuts and Jobs Act. Now it's permanent. You cannot manipulate that. So there's nothing to know. Standard deduction. So you can see it has increased. You can't take any action with the standard deduction again. You need to get applied to your tax return automatically. There's no reason. There's nothing you can change, right? Senior deduction, you're gonna change. And then if you're 65 and above, you get extra deduction, 6,000. So very simple rules, and you can just read this and understand this. So no need to go into more detail on this one. QBI deduction. This is something I was talking to you guys earlier. QBI has been there since 2017 with the Tax Cuts and Jobs Act. This was Trump's way of helping small businesses because he decreased C corps. Think about Amazon's Delta's stuff. He decreased their tax rate from 37 to 21%. And then he wanted to give this QBI deduction for small businesses like S corporations and partnership to equalize the chains. It was not permanent, it's permanent. Now, are you going to benefit from that information I just shared? No. But what are you going to benefit? Same concept as the credit I shared earlier. There's a threshold. If you make more than a certain amount, your QBI deduction goes away. What QBI deduction is, if your business makes $200,000, 20% of that, you don't have to pay taxes, meaning $40,000 you can write off. Very basic concept, okay? But you start losing that to 40,000, it goes away completely if you make $400,000, $500,000 and up. It also goes away if you're in sort of industry. I never get this QBI because I'm in accounting industry. In the law and healthcare, it goes away. So it's same way I was talking about how you manage your income and with all deduction can help you get credit. Same concept. If you can reduce your threshold to a certain amount by other tax planning, buying a vehicle, hiring your kids, S corporation, so many other things which we always talk about. If you can do that, you also get QBI deduction. So interplay between other tax planning and then QBI, it is hard to understand. Like I said, even CPAs cannot connect the dots. That is why you need the software. That's why we're working on it. And we'll give you that in the next few months. Just be patient there. But right now, you don't have to act on it by the end of December. If you could lower your income by other tax planning that boosts your QBI deduction is the goal. Do we have to act on it right now? No. Just understand this how it works. I'm going to talk with my CPA. I'm going to do tax planning with my CPA. I'm going to run my own tax planning in this new software you might get access to by the end of the year. In November and December, if I hire my kid, if I buy a vehicle, let's say you close on a property in November, December, and do cost segregation. How much do I need to buy to lower my threshold? You can run all those scenarios very easily. You can ask AI, okay, I want to do this, and give you the report. But understand the concept though. So just to repeat what I said, just like tax credit, if you can manage your AGI, if you can manage the gross income by implementing other strategies, you get QBI deduction, you get child tax credit. Now, is this a new law? No, it's not. That's why I'm not going to go what QBI deduction is. You can Google this and there are millions of articles. But I'm just telling you how to manage this stuff. There's a threshold and there's also some limitation. Very important concept. It's not written here. S corporation. If you can pay yourself and your spouse W-2 S corporation, QBI goes up. 99% of CPAs miss this, and they always tell you pay as less salary as possible in the S corporation to save FICA taxes, which is not good advice. That's why you need those Interplay software. Our Excel that we always use to do tax planning does that for you. The software is going to do that for you. But if you just go and ask CPA, hey, so how much should I pay to my spouse or me from my own S corporation that I just got from my, I don't know, restaurant or consulting gig, then do not do that mistake. Ask your CPA to run the scenario where QBI is interplayed with your W-2. That's what you're going to tell them and they'll understand, okay? Moving on, R&D expensing. All you need to understand is before you could not write off, now you can write off. It matters to me. I'm spending millions of dollars in this new software. Before I could not write off that $1 million, I had to write them, depreciate them, and amortize them over 15 years. Now, the $1 million I've spent this year on, let's say, TaxMD, it reduces my income, and I don't have to pay tax on the money I didn't have. So it's a good thing for me. Does it apply to you guys? If you just understand what I said, that's the extent of thing you need to understand. If this applies to you, you got your CPAs and will say, hey, you need to do R&D credit analysis and all those things. So just understand that. Business interest deduction. It's not a new thing. It used to be limited. They just changed the way to limited right now. It doesn't apply to most of you people. It doesn't even apply to me. Your business has to make 27 million and up this to come in. So if it applies, don't worry about too much. There's some limitations all you need to worry about. Okay. Only the big thing you need to understand from here is, do you see that gift tax exemption and state exemption? I'll tell you why this is important, especially for a real estate owner. When you die, you do have to pay state taxes. It's very high, it's like 40%. But you don't have to pay that unless you go above 15 million per person. So if your net worth is not 30 million, you'll never pay gift tax or estate tax. People talk about gift tax. Right now, if your parents gift you a property, a real estate, you're supposed to pay gift tax. But if you use this exemption, you don't have to. And a lot of people do that. Normally, your parents should not be gifting you any stocks or real estate because when they pass away, you get step-up basic. But it does not matter if your net worth is not more than 30 million. It's all you need to care about. So from now until you die, if you plan to make more than 30 million net worth, then you got to work with a state attorney to manage your estate, to get a trust, to freeze your asset. If you know that your net worth is not going to be 30 million or more with your husband and spouse, then this really does not bother you. That's why estate planning is for wealthy people. And some of the attorneys will try to sell you this because that's how they make money. You guys do not need to worry about it unless your net worth goes above 30 million. But ignore the estate tax, understand gift tax. Even if you gift your friends and family, your partner, less than 30 million, you will never pay gift taxes, is what you need to understand. It used to be 23 million, you went to 30 million, the exemption changed. It's not a new rule, it's just the threshold change. That's all. The second one is a good one. Before, you used to have itemized deduction to get the charitable deduction. Now you can just get the above the line, just like the car interest. You get to write off 10,000 of loan interest. Now, if you're married and if you give 2,000 to your church, you'll always get benefit for that, even though you don't itemize. There's no need. Even if you do standard deduction, you still get to write off $2,000. It's a good thing. So what's the action item here? There's one action item. It can get as complicated as you want to make it. If you're already itemizing it, always try to lump up all the charitable deduction 1 year because it keeps you above standard deduction. The only action item is if you give charity, it's always better to lump multiple years into one, is all you need to understand. Rather than giving $50, $100, $1,000 every year for 5 years, if you can give $5,000 in 1 year, it's much better from tax savings because it's your highest tax bracket and it gets lumped and you get to deduct itemized. That's all you need to understand. Lump when you're giving away charitable deduction. But this is a new rule. Even though you don't itemize, you still get to write off $2,000 if you're married. As simple as that. Business meals update hasn't changed. Employer provided meals, don't have to worry about it because most of the time it doesn't apply. You still get to write off 50% of your meals, is all you need to understand. Please just document it because IRS will come and ask for your receipts and who do you eat the meals with. That's all. Next phase. Let's talk about international tax change for half an hour. I'm just kidding. No one wants to know. So I'm not going to even go through that. There's a few changes, but it's just reduced. It was already there. We're not going to go over that. So the next thing is personal exemption was gone. It just became permanent. It was $500 per dependent. You don't need to even worry about it. It's gone. Miscellaneous itemized deduction. Before, as an employee, let's say Kinsley works from home, and if she bought a plant or decoration or monitors, she get to write off as itemized deduction. It went away in 2017. It just made it permanent. It's not a new thing. It just went away. Moving expense, still same thing. It was there last year too. You cannot deduct moving expense unless you're in army, and it just became permanent. That's all. There are a few things that we don't need to touch upon, so we did not. It's not even here. So those are all the things we have. Big things. These are not all new things. There are only a few new things like tips and stuff, which doesn't apply to everyone. Things changed. Most people care about bonus depreciation, especially if you is in real estate. Next 5 years is going to be very important for you. Meaning, if you can write off the asset you bought in real estate, you can save 200, 300,000 last year in taxes with real estate. That's a huge win. Let's say for next 5 years, you can save 200,000 loss in taxes every single year. That's $1 million of tax savings next 5 years, which you could have not. That's retirement money without even time value of money. So that's how powerful that is. We can answer some of these questions, and if we have time, I'm gonna just run this bonus depreciation scenario for everyone so they can look at this for 15 minutes. So can you read those questions for me?
One of the questions, is there a limit of what kind of income you can qualify for the Trump savings account?
If you guys are asking, is there any limitation on kind of income, then there's none. Meaning, if there's going to come up with regulation that says things have changed, then it's a whole different story. They have done that before. Right now, there's no limitation. I think it's an age limitation on your kid. You go open up the account, and then you just put whatever amount you want to put in. Trump will fund it first, and then you can start funding the kids account. So there's no income limitation based on what we have seen so far. There is a contribution limit of 5,000. You know this. But there is no this kind of, you can only contribute this from business account or W2 or from interest dividend. There's no income limitation, the type of income or character of income limitation. Next question is, you bought a property in 2024 and you haven't placed in service yet. You're going to place that service in 2025, let's say in June. Do I qualify for 100% bonus depreciation? So far, the answer is yes. If you bought an asset, even in 2024, think about restaurant. You bought a restaurant in 2024, you bought this fridge in 2024, but it was not in place in service. Place in service meaning you start producing revenue for your business, which you did not. You just in the startup phase, you just renovating it. You place the asset in service in 2025, June, then you can write off that asset as placed in service. I always say this, sometime in the previous years, they have came back and said only asset, if you're a purchase was in 2024, it doesn't qualify. They have said that. So am I going to tell you right now that the law is finalized? No, can always go and change that depending on the deficit. And they'll say, you know what? Oh, everyone's writing off everything. We need to cut that. And they will start putting more restricted in a role in when they finalize this in regulations and in the revenue ruling in the next few months. But as of right now, the rule is placed in service is what matters. So even if you had a fridge that you bought or real estate that bought in last year, and if you have not depreciated this yet, it's placed in service after Jan 19 of 2025, and it qualifies for bonus depreciation. Another question which talks about the credits. This is a very important thing, and I'm glad you asked. Some credits are refundable and some are not. Refundable credits, you get that even though you don't have to pay taxes. So let me explain this. Let's say you bought a real estate, you did bonus depreciation, you have zero taxes, you pay zero taxes, but you can still get a child tax credit because a portion of that is refundable. You don't have to pay any taxes to get a credit. Tax credit, by definition, gives credit to the tax you're going to have to pay. But if you have no taxes, then you don't get any credits. Makes sense. But there's some refundable credits like this child tax credit. There's this American education tax credit. You get it back anyway. This is what I was saying about the interplay between multiple strategies. If you try to write off everything and have zero taxable income, sometimes it hurts you from credit perspective. So you need to understand the interplay. That's why tax planning is necessary. You can pay your CPA for tax planning. You can save $6,000 in tax credit. You're always going to get 100% return on your money. That's what tax planning is important. And good news is going forward, you can do this on your own. Okay. And this is the last question we're going to answer. When you try to write off. And if you already qualify for credit, do not write off everything. If you are already over a threshold that you never get credit and you want to write off entirely, then be fine. But if you qualify for some credit, which are non-refundable, and you try to get rid of all your taxes, then you'll never get that credit. That is why working either through a tax planning software on your own or working with a CPA is important for you to run those numbers. The other question is an investment property purchased in 2025, but prior to 20th, eligible for bonus depreciation. This is what I'm saying. It's not a purchase date, it's a place in service date. So even if you bought it for Jan 19th in 2025, but you actually placed in service for February, then it still would qualify based on what the rule as of right now. So purchase date is not what drives the bonus depreciation. Placed in service date is what drives. So you could have bought a property in 2023 and placed the service in 2025 and still qualifies. But I'm just waiting for them to say, never mind. I'm changing this. They might do that. We'll see if they do that or not, but maybe not. Right now, the rule is placed in service date. Next question is, are there safe harbor strategies for using a real estate professional to unlock suspended passive losses or trigger QBI deduction? Someone is asking, are there any safe harbor strategies? Safe harbor means safe harbor strategies for using rep status to unlock suspended passive losses or trigger QBI deduction. There are two things here. Suspended passive losses. I need to give you background information. You become a real estate professional status to unlock passive losses to non-passive. Same thing with a short-term rental, right? But if you already have suspended passive losses, meaning last 10 years you had real estate, you had losses, you never qualified as a professional because you're not retired, your spouse, both of you are working full-time. Now one of you retired or you're working part-time, then now you can qualify as reps. Just qualifying for reps this year does not release your previously suspended passive activity losses, which could be $100,000, $200,000. So someone's asking me, is there any safe harbor? If you qualify as reps this year, can I just release them? The answer is no. But how do you release your suspended passive activity losses? There are basically two ways. The first way is you invest in businesses that might give you passive income cash flow. There are businesses that actually are very cash flow intensive. Let's say some of your friend comes to you and say, I want you to invest with me in vending machines. You should, because they're very low maintenance and they produce income. If you trust your friend and you don't get involved, you're passive, then get some passive income so the suspended passive activity loss gets released. That's the one way. Again, I'm just giving one example. You can invest in any other thing, right? You have suspended passive income from other businesses. The second way is if you have a non-performing asset, repurpose your equity. If you have a non-performing asset, you need to sell that asset so your suspended passive activity losses can be used. Or if you have invested in syndications before, if they're going to exit the deal this year, you're going to get a capital gain. You can use those suspended losses to offset the capital gain. That's how you manage that as well. You can run these scenarios on your own when you do tax planning and tax software going forward. But there's no safe harbor. Rep status has nothing to do with QBI deduction, first of all. But cost segregation does hurt QBI deduction. Meaning, if you have a business, this is how you think. If you have a business, let's say S corporations or a restaurant, and you get a huge income, that can give you QBI deduction. But if you do cost segregation, it's a loss. QBI deduction goes away because they net together. So this is almost useless information for you guys. And here's the reason. Because even CPAs don't even think about it. That's why in our tax planning module, the Excel we have does the calculation to give you right deduction. Our software is going to do that for you guys. But normally, if you just think separately, then you're going to get hurt. You're going to think, I'm going to do cost segregation as a real estate strategy. Also, I'm going to do S corporations. I'm going to pay my spouse to get this QBI deduction. I'm going to get $20,000 tax savings from QBI deduction. I'm going to get $100,000 tax savings from real estate. Boom, $120,000. They're separately correct, but if you merge them together, the QBI deduction goes away. That's why you need to understand the interplay between the strategies. That's what the software does for you. We have another question here. Can I use a personal property and convert it to a rental as long as I place service in after 2020? So when you say personal property, it might be furniture and appliances, or are we talking about real estate? It's not clear. Maybe rental, so maybe it's real estate. Okay. So if you have a primary residence and then you place it in service, this is something that is not clear. There was a rule that came out when the 100% bonus depreciation came out earlier. And then when people went to do cost segregation on their primary residence, all the cost segregation firm said that this property was bought in 1970. And then the law says that the property has to be bought before this year. So what you just asked is not clear. because they have not expanded on the rule just yet. So if you're going to convert your primary residence to a rental property in 2025 and expect to get 100% bonus depreciation, think and ask your CPA to clarify this, especially in the next few months when they come up with a new clarified version of revenue ruling and regulations, because based on previous law, there was a purchase, especially for primary residences, there was date, like when was the purchase date for your primary residence mattered. So the answer to this question is complicated because the rule is new and they have not come up with a rule. So if you are going to think about converting your primary residence or previous primary residence to a rental, wait for the CPAs to give you more guidance on it. Don't just go to cost segregation because it might not benefit you. Talk to your CPA first before triggering the cost segregation, because there might be a limitation on when you actually bought the property versus in a place in service for primary residence. Just so you know. Good question though. Okay. I think those are most of the questions, guys. I know we're almost done with the time. I was going to show you this bonus depreciation. We don't have time for that. We do this every single month, and we're going to do more of this anyway. If you can join us, we'll show this on every single webinar we have, and we're going to do more of this. So thank you everyone for joining. Kensley, thank you so much for helping. If you have any questions, Kensley's going to put this on the screen. Follow us on social media. We share so much information there. Just follow us on one of the platforms, LinkedIn, Facebook, Instagram, TikTok, whatever you're most active, and you'll see us there. We'll talk again. Thank you.